let's talk about something that can absolutely wreck your crypto profits, something many traders unfortunately learn the hard way. We're diving into market liquidity. So let me ask you this. Have you ever been in that spot? Your altcoin is absolutely soaring, you're looking at huge gains, and you go to cash out, and in that one single moment, the whole thing just falls apart. Does that sound painfully familiar? Well, if it does, you've met the silent killer. It's this hidden force in the market that can evaporate your profits in a split second. And believe me, it has nothing to do with whether you picked the right coin or not. All right, so let's walk through a classic crypto nightmare scenario. This is where all the charts and theories get really, really real. Okay, so you're holding a decent-sized bag of some low-cap gem. It's mooning, it's up 50, maybe 100%. You think, okay, time to take some profits. You go and hit sell with a big market order, and instead of a cha-ching, you just watch in absolute horror as the price tanks. Your own trade just crashed the market. What on earth just happened? To figure that out, we've got to pull back the curtain and look at the market's plumbing. And that brings us to the absolute core of this whole thing, liquidity. In the simplest terms, liquidity is really just about how many buyers and sellers are hanging around, ready to trade at any given moment. Think of it like this. It's the market's ability to just absorb your trade without even flinching. And this is where you really see the difference. In a high liquidity market, say for Bitcoin, you can drop a huge sell order and the price barely budges. It's a nice, smooth exit. But try that in a low liquidity market. That same exact trade can cause a total price collapse, simply because there aren't enough buyers on the other side to soak it up. In this right here is the villain of our story. That gut-wrenching gap between the price you expected to get and the much, much lower price you actually got, that, my friends, is called slippage. It's that silent killer we're talking about. So how does this whole train wreck happen? Well, it's a cascade. Your huge sell order hits the market and bam, it instantly fills all the buy orders at the current best price. But your order's not done yet. So it keeps going, chewing through the next level of buy orders at a lower price, and then the next, and the next. By the time your entire order is finally filled, you've single-handedly driven the price into the ground. Okay, so that's the problem. And yeah, it sounds pretty scary. But the good news is, it's not some unavoidable fate. So let's flip this around. How can you spot this risk before it costs you a fortune? Here's the secret. You have to get proactive. Instead of finding out about low liquidity the hard way, you check for it before you even place the trade. And luckily, there are two really simple but super powerful metrics you just have to add to your checklist. These are your new best friends for dodging slippage, order book depth, and 24-hour trading volume. Seriously, think of these as your built-in liquidity radar. When you see a deep order book, lots of buy and sell orders stacked up close to the current price, and you combine that with a high 24-hour trading volume, that is a sign of a healthy, liquid market. That's your green light. It tells you the market can probably handle your trade, no problem. I mean, just look at the difference here. On one side, you've got a safe bet like Bitcoin, maybe with billions in daily volume. On the other side, a risky bet, some obscure token might have just a few thousand. Trying to sell a big position in that risky market, it's like trying to drain a swimming pool with a fire hose. It's just going to make a huge, messy splash. All right, so knowing how to spot the risk is half the battle. Now let's talk about what to do about it. This is how the pros protect their capital in these tricky waters. Here is the pro playbook. First, never, and I mean never, market sell a huge position all at once. Break it up. Feed smaller orders into the market to lessen your impact. Second, use limit orders, not market orders. This is so important. A limit order lets you set the absolute minimum price you're willing to sell for. It's your safety net. And third, hey, when in doubt, just stick to the major high liquidity coins. So where are these safe havens? For any big trade, you want to be looking at major pairs like Bitcoin or Ether against a stablecoin, and you want to be on a top-tier exchange. These markets are liquid for a reason. That's where everyone, including the big institutions, is trading. Now let's reframe this whole conversation. Because understanding liquidity isn't just about playing defense and avoiding disaster. It's actually about gaining a real strategic edge. Think about it. Most retail traders completely ignore this stuff. So by paying attention to liquidity, you can plan your entries and your exits way more effectively. You start thinking not just about what price you want, but how your trade will actually execute. And that, right there, is a massive level up. This quote just says it all, doesn't it? Execution risk can be as damaging as market risk. You can be 100% right about where the market is going, but if you can't get your trade through at a good price, you still lose. The risk of a bad exit is every bit as real as the risk of the price moving against you. And just think about that for a second. You could grind out 10, 20, even 50 small winning trades, but it only takes just one, catastrophic exit in a low liquidity coin to wipe out all of that hard work, and maybe even more. And at the end of the day, that's what this all comes down to. Understanding and respecting liquidity is the line in the sand between a smooth, professional profit take and accidentally being the person who crashes their own investment. So I'll leave you with this question. Go look at your portfolio, especially those smaller, exciting altcoins you're holding. Now that you know exactly what to look for, are you really paying attention to the silent risk hiding in there?